A very good morning to all our valued investors. I hope you're all safe and doing well. Thank you for joining this special investor education session that we conduct on a monthly basis on the fourth Saturday of every month. And I'm Satish Prabhu, your host for this session, and I'm part of the marketing team at Franklin Templeton. You may note that this is an investor education session, and as per regulations, we would not be discussing any of our products in this session. So request you to kindly bear with us for that. Before we move to the main agenda for today, let me introduce you to our esteemed speaker, who I would say actually needs no introduction. He's a multifaceted personality. He's a mentor, he's a coach, he's an author, and he is, he's also a trainer for all mutual fund intermediaries. He has trained more than 70,000 intermediaries over his 35-year career. And among the books that he has penned, there are three of them. The first one being Make Your Destination a Journey to Remember through Financial Planning. The second one being Pearls of Financial Wisdom. And the most recent one that he has written is Think Hatke. I would say that each of his book is unique in its own way and provides key insights to investors. His articles and his professional journey are motivational, thought-provoking, and always evolve positive vibes for readers and listeners. Please welcome our esteemed guest for today, Mr. Sunil Jhaveri, and you would all know that he's also popularly known as Mr. Bond. So before I move over to Sunil, let me set the context for today's session. In a span of just 1 week in June, we saw that the RBI raised interest rates by 50 basis points on June 8th. And this was followed by a 75 basis points hike by the US Federal Reserve on June 15th. So all of this happened in a span of just 1 week. While both hikes were on expected lines, the US hike was the first one, the biggest one seen since 1994. The biggest challenge all central banks are trying to fight now is the rising inflation. And you would all know that in India, the retail inflation stands at over 7%. And in the US, it stands at 8.6%, which is higher than in India. So what does this mean for investors, and how does one invest from here on? In fact, we talk more about equities and less about other asset classes. Perhaps there is one asset class which is more ignored than the other. And to hear more about that asset class, let me hand over the floor to Sunil Jhaveri to share his thoughts and guidance with our investors. So without much ado, I hand over the floor to Sunil. Over to you, Sunil.
Thank you so much, Satish. Good morning, everyone. My name is Sunil Jhaveri, also known as Mr. Bond in the mutual fund industry. Now, let me explain to you why Mr. Bond and the context of today's session also. Mr. Bond, as in bonds and stocks, I was managing treasuries of corporates, banks, and institutions when I was an advisor myself. And that's the reason why I became a debt specialist, because most corporates and institutional investors invest in debt as an asset class, not in equity as an asset class. So that became my forte, that became my niche. And that's how Mr. Bond name came to be associated with me. And of course, now I have a domain name, mrbond.in also. So as you must have rightly guessed, and as already Satish has already revealed as to what is the topic and what is that mystery asset class, the mystery asset class is nothing but debt as an asset class, the most ignored asset class, most misunderstood asset class. And I'll try and demystify debt in a very simple manner, in a layman's terms, so that you understand why debt through the mutual fund also makes a lot of sense. Equity is a volatile asset class. Everybody knows it and they don't mind that volatility. But when it comes to debt and the volatility, when there is volatility in debt as an asset class, is when investors try and shy away from investing, not realizing that there are strategies which really make sense for investors. There will be times when debt as an asset class makes a lot of sense for investors. There will be sideways consolidation in different asset classes, and I'll share some data which are really eye-opening data And you'll be shocked to see as to, when we think that only equity can deliver long-term returns. I will share one data which will really, shock you all and make you look at debt with a different eye altogether. So let me start the presentation. We say think equity, think long-term. I'm saying think debt also and think long-term. In debt also one has to think long-term because there are various different issues attached with debt as an asset class also. So the first and foremost, you must remember there is a big risk of reinvestment risk. We have never thought of reinvestment risk associated with any of these asset classes, especially in the debt. Let's assume that 20 years back or 30 years back, if you had invested in a fixed deposit, if there was a bank deposit which was there for 25 years, I don't recall that there were bank deposits for 25 years, and you had captured 15 or 20% rate of return on those deposits, and you would have held on to those deposits till now, 25 years later also, there would have been zero reinvestment risk. 15% return आपको मिलता है, तो why would you look at any other asset class? But because interest rates started falling, and I'll share some data as to why interest rates are falling in some of these developing countries, developed countries also, and that will set the context in terms of how to understand debt as an asset class. But let me start with the basic. The first question we must answer and understand is interest rate की direction किस तरफ जा रही है? How is the interest rate moving in the direction of rising interest rates or falling interest rates? What are the different constituents in the markets, debt markets, which determine the rate of interest, whether they are going to be rising or falling? Once you understand that as a concept, I think it will be easier for you to at least judge and gauge as to where the interest rate should be headed, going up or going down. Interest rates get determined by total credit in the system. Credit का मतलब क्या होता है? When we buy something from the grocery store and say we'll pay you next month, that's credit. When corporates borrow from banks, when they say we will pay you over a period of time, that is credit. When governments borrow in for managing their fiscal deficit, that is credit. So ये जो total credit in the system जो होता है, that gets further divided into external credit and internal credit. And external credit gets determined by what we call current account deficit. Now, what is current account deficit? It is the difference between the country's exports and country's imports. India being crude oil dependent in terms of imports, 70% of our crude is imported, and gold also is imported, plants and machinery are also imported. So various other issues are there. So India as a country would generally have current account deficit and not current account surplus. Uska matlab ye hai, they will be net importers and imports would be more than the exports of the country. Now when you're importing more, and if the oil prices are going up the way they are going up currently, and because of that dollar is appreciating and rupee is depreciating, slowly and steadily we get imported inflation, imported through inflation, through dollar appreciation, through crude oil prices going up, etc. All that gets reflected into the economy in the Indian context. Whenever current account deficit starts to rise, you must understand that interest rates will be on the rise and not on the downward trajectory. And if you are going towards current account surplus, or even if you are closer to current account, which is balancing between a country's exports and imports, that means the interest rates will be on the softer side. Where are we currently? Naturally, we are on the current accounts deficit side, on the higher current account deficit side, because of the crude oil prices which have shot through the roof, dollar which has appreciated against all other currencies, including India. There is an inflation which is ruling across the globe, and that is also reflected in the Indian context also, which is what we say imported inflation through crude and dollar appreciation. So interest rates should be on the rise in the current context, and they are on the rise, as Satish has rightly pointed out. In the internal credit, we divide that into private sector credit and government credit. What is private sector credit? जब भी कंपनी को बोरो करना पड़ता है टू फॉर देयर कैपिटल एक्सपेंडिचर, फॉर वर्किंग कैपिटल रिक्वायरमेंट्स, द इकोनॉमी इज डूइंग वेल, they are spending more on expansions, etc. So that's what we call credit offtake. कि companies जो ज्यादा borrow करती है, credit offtake ज्यादा होता है, there is a pressure on liquidity. Naturally, at such points in time, interest rates will be on the rise because liquidity is under pressure. It is more in demand. It's a demand supply situation. If the liquidity is more in demand and supply is less, naturally interest rates will rise. Again, currently, the credit offtake has started picking up in the Indian context, and we are seeing interest rates rising because of that reason also. From the government context, it means fiscal deficit. Fiscal deficit का मतलब ये होता है जो government every year when the budget के time ये लोग एक announcement होती है fiscal deficit number की. It is nothing but difference between the government's expenditure and the government receipts or revenues. Government expenditure is on various projects, subsidies देते हैं, roads and bridges बनाते हैं. So all these are the spending as far as government is concerned. That the revenues get generated from direct tax collections like income tax, etc. From even the indirect taxes like GST. So all this becomes part of the revenue, and then there is a spending also. Post-COVID and various other issues which have cropped up for the government, the fiscal deficit numbers are on much higher side than what they had estimated. Naturally, all these points out that interest rates will definitely be on the rise going forward also. Current account deficit on the rise, interest rates will be on the rise. Credit growth on the rise, interest rates will be on the rise. Fiscal deficit on the rise, interest rates will be on the rise. So if you understood the basic agenda and basic understanding of all the constituents which will make interest rates rise or fall, you will be able to judge and gauge whether you should invest in debt as an asset class, or should you be investing in some other asset classes. Should you be going long-term debt, or should you be investing in short-term debt, and so on and so forth. What do investors need? Basically, they are looking at leaving behind a legacy कि हमको हमारे बच्चों के लिए कुछ छोड़ के जाना है. Preservation of wealth, whatever I have earned and accumulated, I want to preserve that wealth. And finally, meet long-term goals. These are the three basic criteria for which investors save and invest. And most of them believe that this can only happen through equity as an asset class to meet long-term goals. But there is debt as an asset class, and we had covered this aspect very beautifully in the first session of Frankly Speaking when we spoke about asset allocation. In asset allocation, there are different asset classes which form part of your portfolio because one asset class may perform and the other asset class may underperform. Currently, equity is underperforming. Maybe this is the time. It's like a golden opportunity where debt will start performing, and I'll explain to you how to look at debt and when to invest also. Investors and advisors think short term while investing in debt schemes, unfortunately. Exits are made post exit load khatam ho gaya, ek saal ka exit load tha. If the exit load application is over, they exit out of debt as an asset class. The long-term capital gains tax, which is now applicable on the debt side with 3 years of holding and thereafter indexation benefit in the debt as an asset class. Once that is achieved, then they exit out of debt as an asset class, not realizing that they should continue to stay invested till you don't need that money and you've not met various objectives and goals of yours. So don't think short term when it comes to debt by just when the exit loads are over, exit out of it, or long-term gains tax applicability is over, so you exit out of debt and so on and so forth. Look at debt as long-term as what you are looking at for equity also. I just explained to you in the beginning of my session that if we had a bank deposit earning, you say 15%, 20 years or 15 years or 20 years back, and if you had locked in those returns, I don't think you would have needed to look here and there. Currently, if the bank deposits are quoting at 7.5%, imagine the reinvestment risk for those investors. In fact, last year when the interest rates were absolutely on the softer side, interest rates and the bank deposit rates had gone down to as low as 5.5 to 6% also. How can investors make ends meet when the income is falling, expenses are mounting, and they have not understood the meaning of reinvestment risk? Every time when you are investing in debt for 1 year, 2 year, 3 years, let's assume the interest rates are at the peak currently, ideal way of looking at debt would be to lock in longer duration in the debt space so that you avoid reinvestment risk. But if you invest today only with a 1 year view in the debt markets, naturally if the interest rates soften year after, let's assume the interest rates are at say 8% currently, and if the interest rates soften in the next year, year and a half or 2 years, and they go down to say 6% again, will you be able to manage your expenses out of the income which you will generate going forward? That reinvestment risk is a very important criteria of why you should be investing in debt for long term, especially when the interest rates are at the peak. Transitioning from developing companies to developed countries, and if you will see this data, you will understand that when the countries are moving from developing to developed countries, the interest rates tend to fall dramatically. India will be among the top 3 economies in the world in the next 2 decades or so. Naturally, we are going to be moving from developing to developed country in the next 2 decades or so. If you're getting any opportunity of investing in debt at higher levels, this is the time to capture that, because the data in the next slide will explain to you how developed countries, the interest rates have fallen dramatically. From 2000 to 2018, if you see in the US context, South Korea, Germany, China, and even in the Indian context, interest rates have dropped by almost 30% to 90%. If you see Germany, 5.5% to 0.55%. Come to 31st of December 2019, when Germany actually went into negative interest rates zones. This is the first time it would have happened in the debt markets. And as you can see, from 54%, USA went down by 9 to 71%, South Korea from 66 to 79, in Indian context also 29% to 40%. Now let's see where we stand as we speak currently. So if you see, as on 23rd of June 2022, even in this context, USA has fallen by 52%, South Korea 54, Germany 74%, though it has come into the positive territory from the negative interest rate regime. India is also at 33%. So when the countries are going to be transitioning from developing to developed countries, and these are some of the developed countries, as you can see, over a period of time, in the next 2 decades, if we are going to be a developed country, India as a country, then naturally we should be looking at interest rates softening dramatically. And that's what we need to capture at the current juncture when interest rates, these are golden opportunities not to be missed. These are once in a lifetime kind of opportunities where inflation has gone through the roof thanks to the central bank's loose monetary policy, printing of money, helicopter money, etc. And thanks to that, there is a global inflation which has happened 4-decade high. ये 40 साल में जितना इन्फ्लेशन नहीं बढ़ा था, वो इस साल में इतना बढ़ गया है. जो 40 साल पहले इन्फ्लेशन था, आज यूएसए में 40 साल के बाद ये इन्फ्लेशन आया है. These are the opportunities, and because of that, because of the crude prices going up, commodity prices going up, etc., imported inflation through current account deficit, what I've just explained to you, in the Indian context also, this is a golden opportunity of capturing higher yields, maybe in the next month or so, when RBI will continue to raise interest rates. But slowly and steadily, one must look at debt as an asset class. Do not ignore this asset class. Let us understand the basic. Why do investors gravitate towards bank deposits, NCDs, or tax-free bonds? The unfortunate part is they believe there is no volatility in these instruments, as there is no daily net asset value declared. Mutual fund ki jo net asset value is declared on a daily basis, and that's the reason why they see volatility in the mutual fund debt space. They are not able to visualize this volatility in tax-free bonds which they have bought, or bank deposits where there will be a reinvestment risk, or non-convertible debentures if they had invested in bonds directly. But if they try to sell these in the secondary market, that is the time then they will realize that yes, I had bought it at 100 rupee, interest rates have gone up, and I'll explain to you the reverse correlation between interest rate and the price of the bonds. Then they realize that, oh, I had bought it at 100 rupee, but I'm trying to sell this just now. I'm only getting 90 rupees, is when they will realize what is mark to market and why they are treating these tax-free bonds and other instruments in the debt space as hold to maturity, that I will not look at the daily fluctuation. It does not bother me. But the same should be applied when they are looking at investments in the mutual fund in the debt space. But because the daily NAVs are there and we have a habit of looking at our investment portfolio returns on a daily, weekly, monthly basis, that's what perturbs us. That volatility perturbs us, and they think that, oh, if you invest in debt through the mutual fund route, it is more volatile than if you had to invest in direct instruments like tax-free bonds, etc. But that's a misnomer. That's just to satisfy your mind and peace of mind, saying that isme to koi NAV hai nahi, daily price to main dekh nahi raha hu, so why should I bother about it? I'm going to hold this for the next 10 years if I bought a 10-year tax-free bonds. So I do not wish to look at the prices on a day-to-day basis. When you buy a property or when you buy, say, jewelry, have you ever thought of looking at the price of that jewelry or the property on a regular basis? You think of these as multi-generation assets. Similarly, you'll have to start thinking of instruments which you are investing in the financial products, which includes equity mutual funds also and the debt mutual funds also, as multi-generation assets. Move away from looking at them on a regular basis. Then only you will have peace of mind, and then only you will be able to bear the fruits of what you have invested in. If they try and sell these in the secondary market, as I explained to you, you will understand what is mark to market. Mark to market ka matlab ye hota hai that in the mutual fund space, on a daily basis, if these securities are getting traded, they have to price that daily movement in the security prices. But because tax-free bonds, you are not bothered at looking at the day-to-day market prices, and there is no daily NAV attached to it. That's the reason why you don't look at it on a daily basis or on a regular basis also. So start looking at investing in the debt space in the mutual fund route, but stop looking at the regular movements of the NAVs. And also understand the meaning of reinvestment risks. I've just explained to you, if we had captured 15% bank deposits few years back, 10 years, 15, 20 years back, when the interest rates were on the higher side, and you would have held on to that particular bank deposit till date, आपको equity में डालने की भी जरूरत नहीं पड़ती. But unfortunately, we look at bank deposits also with a 3-year and a 5-year view only, and we invest in that. And thereafter, when the interest rates start to come down, there will be a huge reinvestment risk. Now let me explain to you the negative correlation between the interest rate movements and the price of the bonds, underlying bonds. How do we generate returns in the debt space? We generate returns through the yield which we capture. Yield ka matlab ye hai, if you are buying a NCD, non-convertible debenture of 10% coupon, let's assume you bought it from the primary source, from the company itself, that 100 rupee face value, 10% coupon becomes the yield for you. But if you had bought it in the secondary market, whatever is the market price which you paid, so instead of 100 rupee, you may have bought it at 110 rupee, that 10% coupon, naturally your yield will be lower than 10%, maybe at 9% also. The yield is the rate at which you have captured that at the time of investments. It can be a coupon, directly buying it from the company, or you could have bought it in the secondary market, a 10% coupon bond, but if you bought it at 90 rupees or 100 rupees or 110 rupees will determine your yield. So yield of the bond plus minus capital gains or capital loss. How do you generate capital gain or capital loss? Accrual for an investor is yield of the security. आपने एक yield ले लिया है, 10% का yield आपने capture कर लिया है by buying it in the market, and capital gain is the increase in the value of the underlying debt security that gives it a higher worth than the purchase price, and vice versa. You may have bought it at 100 rupees face value, but because the interest rates have softened, the underlying bond price has gone up to maybe 110 rupees. That 10 rupees is capital gains. So what you will earn is that 10% coupon, which is your yield, and accrual for the period, number of days or number of years which you will hold on to it. You will definitely get that accrual. And if the interest rates have softened from 10%, it has come down to 9% or 8%, naturally the underlying security price will go up, and I'll explain to you how. And that's how you will generate capital loss. But during this period of holding of 1 year, 2 year, 3 year, if the interest rates have gone up instead of going down, the underlying bond prices will go down, and naturally that is the time when you will have some capital loss also in your portfolios. So let us understand this with an example. The yield which you have captured is 10%, face value is 100 rupees. Interest rate goes down to 9%. That means the price will go up to 111.11. 10% coupon into 100 divided by current yield, which is 9%. So that 11 rupees and 11 paisa is your capital gain. One, you got earned 11 rupees and 11 paisa as capital gains, plus you would have earned that 10% coupon for the number of years or months which you have held on to this security. And this is the reason why you would have earned a higher price on that bond, because interest rates have softened. But what if the interest rates had actually gone up instead of going down? In that sense, you will have some capital loss also. In that case, 10% into 100 divided by 11%, which is the current market yield of that particular security, your price of the bond will be 90 rupees and 90 paisa. That means there will be a capital loss of 9 rupees and 9 paisa. 9 rupees and 10 paisa, sorry. This is how you earned returns on a debt instrument. The coupon, the yield which you have captured, plus capital gains, or yield which you have captured less capital loss. Because of that yield which you have captured, and especially when you capture the yield at the higher levels like the current situation, naturally that accrual is on a higher side, so that capital loss as and when it occurs may not impact you so much, and I will explain to you with an actual example also. When should you invest in equity? Unfortunately, we don't have a chat box which is open. Naturally, you should invest in equity when the market valuation is cheap. I'm not looking at the Nifty number or the Sensex number. That has no correlation to when you should invest. If I ask you this question, that January 2008, Nifty 50 was at 21,000, sorry, Sensex was at 21,000 levels, and currently the Sensex is at say 56, 57,000 levels. Which is more expensive? When should you invest? Naturally, many people say 57,000 is more expensive than 21,000. But that's not the way you look at when to invest and whether the valuation is expensive or cheap. In Jan 2008, the Nifty PE was at 27 or 28, and Nifty PB, price to book, was at 6.5. And the current levels also, we have not touched those kind of levels. So Jan 2008, Nifty was more expensive than what it is currently. As on 9th of March 2009, 1 year later, Nifty Nifty value came down from 6,144 to 2,573. That means price of a bond. If you compare this as a bond price, it had come down in terms of price, and the PE had come down from 28 to 12, and PB had come down from 6.5 to 2.14. The simple question is, when should you invest, and when do you expect that if you invested in Jan 2008, the probability of making money is more, or if you had invested in March 2009, when the values had gone down dramatically, the index had gone down dramatically, price to earning, price to book had gone down dramatically. Is that the right time to invest, or was Jan 2008 the right time to invest? Naturally, the answer is that ideally, and the most appropriate time of investing in equity was when the valuation was at its cheapest, which was in March 2009. Now let's take the same example and the same chart if I had to convert this into yield of a debt instrument rather than looking at it as an equity instrument. Let's assume that this is actually the same Sensex chart only, but if I convert this into a yield chart, yield was at 7% in the beginning with a face value of 100 rupees. And at the end of the year, if the yield has gone up to 9% and the face value of the market value of the bond has come down to 77 rupees and 77 paisa. 7 into 100% divided by 9. The way I explained to you, the reverse correlation between the price of the bond and the yield. Interest rates went up from 7%, it went up to 9%. The price of the bond went down from 100 rupees to 77 rupees and 77 paisa. Unfortunately, most of the investors panic at such stages and they exit out of debt as an instrument the way they try to exit out of equity. When the valuation is the cheapest, they are trying to exit out of it because markets have corrected. Something similar is happening when the interest rates go up from 7% to 9%, which happened in the year 2013. Investors wanted to exit out of debt instruments at 9% when it was the cheapest valuation to invest. If you invest at 77 rupees and if the interest rates soften from here on, and as you've understood that if the interest rates soften, the price of the bond will go up. If 77 rupees starts going up to 100 rupees, what is better for you as an investor? Investing at 77 rupees or investing at 100 rupees? Answer is clear and answer is unequivocal that you should invest when the interest rates are at its peak. That's not the time to disinvest. That's the time to invest in debt as an instrument. So please understand, we are getting this opportunity where interest rates were on the softer side last year. We are going towards a rising interest rate scenario. Even the central banks are increasing rates, and that is also will catapult the interest rates to a higher and higher levels. At some point in time, there will be a peak of the interest rate, maybe in the next month or so, when the RBI may further increase interest rates to control inflation. That is the time which is like a godsend opportunity in debt as an asset class, which is the most ignored asset class, where people have stopped investing and looking at it altogether and only concentrating on one asset class, which is equity as an asset class. And all of us know that equity currently is in a volatile zone. Why long duration bonds are more volatile? Let me explain to you that also. Longer the duration, higher the modified duration. What is modified duration? Modified duration is sensitivity analysis of 100 basis point change in interest rates to change in bond prices. If the interest rates go up by 1% and if your modified duration is 5, that means the change in bond prices will be 5%. If the interest rates have gone down, naturally it will be a positive impact on the bond prices. If the interest rates have gone up, naturally it will be negative impact on the bond prices. If interest rates go up by 2%, modified duration is 5. That means the change in the bond price based on that modified duration is 10%. So higher the modified duration, more will be the volatility and the underlying debt instruments. That's the reason why when the markets interest rates are on the rise, investors are advised to invest in shorter duration products or debt schemes so that the volatility, the modified duration in shorter duration will be on the lower side. Impact of interest rate change will be minuscule in the shorter duration products like liquid funds, ultra short-term bond fund, etc. And that's the reason why you should be in shorter duration when the interest rates are on the rise. But when the interest rates have peaked, and that will be the time to capture higher yields in your portfolios to benefit from softening of interest rate cycle going forward. You will be shocked to see this particular chart. Please make note of this and listen to what I have to say very carefully. These are two asset classes. This is one asset class from 2008 to 2018, 10 years. I'm not trying to showcase that which is better, which is worse, but I'm only trying to showcase to the audience today that we are ignoring some asset classes, thinking the other asset class will always deliver returns for us on a long-term basis. And according to me, this is a 10-year long-term period, long enough period for you to compare equity as an asset class with some other asset classes. Now look at the other chart. This is the orange line of one asset class. This is the blue line of the second asset class. Look at the NAV movements of the blue line versus the NAV movement of the orange line. And the blue line finally has delivered much better returns. Can you guess what is that blue line and what is that orange line? And what is the return during this period of 10 years? The blue line is nothing but 10-year GSEC constant maturity, which means anytime you invest in a GSEC, it will always be a 10-year product. You will be investing in a constant maturity 10-year GSEC. If you had invested on 1st of April 2008, on 28th of March 2018, 10-year long year, it has delivered 8.5% return. During the same period, if you had invested in Nifty 50, it has delivered 7.88% return with the volatility which is so visible in these two charts which I have shown to you. But unfortunately, we have a habit of thinking. Our analysis, our biases only make us believe that only equity can deliver long-term returns. That's the reason we should only stick to equity as an asset class. But asset allocation tells you to look at different asset classes, because when one asset class is underperforming, the other would be outperforming. If you see this data here, 10-year GSEC has outperformed Nifty by a big margin till 2013, when the markets had gone nowhere. From 2010 to 2013, markets had delivered no return, if you see from year to year. But during that period, if you were in debt as an asset class, which was delivering returns to you, but we ignored not investing in debt as an asset class, we continued to stay invested in equity as an asset class and got frustrated thereafter because it did not deliver returns for 2 to 3 years also. I'll share some data as to how sideways consolidation also takes away possibility of earning returns on some of your asset classes. If you had invested in a 10-year constant maturity product on 1st of April 2008, the data which I just shared with you, at that time the yield was 7.93%. But as on 30th of September 2013, when interest rates went up to 8.76% yield, in spite of that, this particular asset delivered 7.4%. Naturally lower than 7.93% because the accrual would have been 7.93%, but there would have been some capital loss because 7.93% yield went up to 8.76%. But because of the higher accrual from 2008 to 2013, there will be some capital loss got cushioned into that accrual, and you got return of 7.4%. But if you had held on to that 10-year constant maturity product for 10 long years, like a hold to maturity, the way you look at tax-free bonds or bank deposits, etc., the return for you was 8.5%. You captured 7.93% at the time of investment. Interest rates were at 7.4% at the time of disinvestment after 10 long years. That means you got accrual of 7.93 or 8% accrual plus some capital gains that delivered 8.5% for you as an investor. Look at debt. There will be intermittent volatility. You will have to ride that volatility. You will have to ignore that noise at that point in time if you wish to generate these kind of returns through these kind of products like constant maturity or constantly rolling down schemes, etc. And I will explain to you what is constantly rolling down schemes also. But during the same period, if you see from 1st of April 2008 to 30th of September 2013, Nifty delivered 3.53%. I'm not comparing debt with equity. That's not my intention. My intention to showcase to you is that we are ignoring one asset class versus the other asset class, thinking that only one asset class can deliver long-term wealth for us. But asset allocation and a proper asset allocation and investing in the right asset at the right valuation is very important. People lose more money in sideways consolidation than they lose in corrections also. So let me give you some examples. Real estate delivered no returns from 1995 to 2003 and 2012 to almost 2020 or 21. Dow Jones delivered no return from 2000 to 2012 in the US markets. In the Indian context, Sensex delivered zero return from 92 to 2002. Post Harshad Mehta scam, if anybody had invested in 1992 and held it for 10 long years only in Sensex as an index fund, there was 0% return on the Sensex from 1992 to 2002. But during this period, there was a structural bull run in the debt market. Interest rates were at 15 to 20% levels, mid 90s, and RBI started cutting interest rates practically on a quarter-on-quarter basis. If anybody would have invested in income funds with a one-year view also, on a yearly basis, they were making double-digit figure returns during this period from 1995 to 2003. In 2003, the interest rates came down from 15% to a low of 5% thereafter. So that was a structural bull run, and we ignored that because we thought equity only can deliver returns for us. But if somebody would have just looked at debt as an asset class with the kind of valuations which were there in the debt markets, investing in the right asset class at right valuation, interest rates were at 15%. That means the values of the underlying bonds would have been at 65, 70 rupees, 75 rupees. And if the interest rates were falling, that means the bond prices would have started going up. That is the one which we need to capture, which is the current scenario. Gold delivered no returns from 1990 to 2005 for 15 long years. If you would have held on to gold as an asset class, there was absolutely zero return. This is the reason why a proper asset allocation is very, very crucial for every investor's portfolio. As against long duration, which get negatively impacted when interest rates go up, very short duration schemes capture rising yields and benefit the investors. Examples, liquid funds. Naturally, if the liquid fund returns was say 3% just a month or 2 months back, because the yields have gone up, immediately liquid funds will start delivering better and better returns based on the underlying captured yields. Something similar will happen in ultra short-term bond funds also, and floating rate bond funds also participate when the interest rates are rising. Floating rate bond fund will deliver better returns by participating in higher and higher interest rates. That's why they are called floating rate bond funds. Now let me explain to you how should you position your debt portfolios and how should you think debt as a long-term product. Think of it as an open-ended FMP. Open-ended FMP means fixed maturity plan. What is fixed maturity plan? There were FMPs which were close-ended FMPs. That means the underlying security, if the FMP was for 3 years, the fund manager would have bought the 3-year product and the 3-year paper, underlying securities. They would have captured a yield of say 6, 7, 8%. If the investors invest in that, they have no exit option, but they had to exit only after 3 years were over, after the close-ended product was opened, and then they would have got their money back through the yield which they had captured less the expense ratio. But how do you treat this as an open-ended FMP? Because the other debt schemes are open-ended schemes where you can invest at any time and disinvest at any time. What you need to look at, some of the schemes which follow constantly rolling down maturity, and I will explain to you what that means also, or the one which I just showed you, the 10-year GSEC constant maturity funds, which you invest, automatically your money will get logged into the 10-year GSEC yield at that point in time. So the 10-year GSEC yield today is 7.5%. If you invest in 10-year constant maturity GSEC fund, you will immediately capture that 7.5%. If the interest rates go up to 8%, you will capture 8% and so on and so forth. So invest in these kind of schemes when the interest rates are at its peak. Works well in a steep yield curve, and I'll explain what is a steep yield curve also. Either you hold it till maturity, the way I explained to you, if I have captured, say, I've invested in a 10-year constant maturity GSEC fund, I have captured, say, 8% yield currently. I hold it for 10 years, I will get my 8% return over that 10-year period. In between, if the interest rates soften in the next 1 year, 2 year, 3 year or 4 years time, I will get that accrual of 8% for that 3 year or 4 year or 5 year period, and I will participate with capital gains also if the interest rates have gone in my favor. So treat this like an open-ended fixed maturity plan. Invest when the yields are at the highest levels. Hold it for 1 year, 2 year, 3 year, 5 years. If the interest rate go in your favor, exit out of it or hold it till maturity, then the capture yield is what you will generate as your returns in your portfolios. What's a steep yield curve? An investor, a borrower wishes to pay higher yield for a longer dated security. If it is a 10-year paper, a borrower would like to pay, or even the investor would like to earn higher yield for a longer dated because the risk is for longer period. So higher, longer duration paper will have a higher yield of 10% and shorter duration will have lower yields. So if you are dividing 1 year, 3 year, 5 years, 7 years and 10 years, 10 year will have the highest yield, thereafter 7 years, 5 years and so on and so forth. So let's assume that if you capture a higher yield of 10% in the 10-year paper, just as an example, it can be a corporate bond, it can be a GSEC, whatever is the yield. If you capture that in a high steep yield curve scenario and you hold that investment in a constantly rolling down maturity product, what will happen is 2 years down the line, that same paper, because it's an open-ended scheme, and if the fund manager gets more money into that scheme, after 2 years, that product becomes an 8-year residual maturity paper, product. So what they will do is with the new fresh inflow of money, they will buy 8-year duration paper instead of a 10-year duration paper. But because it's a steep yield curve, that 10% could have come down to 8% in yield. And those who invested at 10%, by holding it for 2 years thereafter, they've captured that higher 10% yield also, and they would have got some capital gains in their portfolio also. So when identify constantly rolling down maturity schemes, invest in those products at the higher yields, which is happening currently in the next month or so. I think we should be at the peak of interest rate cycle where RBI would be raising interest rates going forward also. And thereafter, if the interest rates are softening, you have an option of exiting with some capital gains and a higher accrual, or you hold it for that period of 3 years, 5 years, 10 years, whatever is the captured papers of that particular scheme, hold it till maturity. Whatever is the captured yield which you've done now, you will get that as your return in your portfolios. This is how you treat this as an open-ended FMP. Position 2, treat your bond funds as multi-generation investment. Leave behind a legacy. The way you think of jewelry on your property as a multi-generation asset, think of your financial assets, including your debt schemes, including your equity schemes as long-term and multi-generation assets. After you, there is your beneficiary who can take that journey forward. Do not think of it as a single generation. It's not going to get over in your generation. If you wish to pass behind a legacy to your beneficiaries, treat this as a multi-generation. Position 3, alternate to tax-free bonds. Very few debt products for such long-term horizon. Better liquidity along with tax efficiency. Tax efficiency because in the debt markets, we get indexation benefit. Government, the income tax department gives you an indexation index on a yearly, inflation index on a yearly basis, based on which if you have bought it at 100 rupee face value, but because of the underlying inflation on a yearly basis, that 100 rupee gets multiplied by that index, inflation index, and your actual cost of acquisition can go up to 105, 106, 110, depending on the index, inflation index. So that becomes your cost value. So your capital gains comes down to that extent. And then thereafter, whatever is the final capital gains after the indexation, you end up paying 20% long-term gains tax after 3 years. So it has a better tax efficiency also. And tax-free bonds, etc. are very difficult to sell in the secondary market. But if you are investing through the debt mutual fund space, it's an easy redemption process, T+1 in most of the debt schemes. So you give your redemption today, your money will be back in your account the next day also. To meet your long-term goals like education, marriage, your retirement, etc., why only equity as an asset class? Debt also should be part and parcel. I'm sure all investors would be having some investments in PPF, bank deposits, etc. All that is part of the debt component, but adding mutual funds into that will make it a better tax efficiency, better liquidity, and a possibility of better returns also. This is a very interesting slide, deferred annuity, I call it. If you invest for 10 years, but you defer your withdrawal only after 5th year, that means you defer the SWP. For the first 5 years, you earn returns on that particular 10-year paper. Let's assume it is earning you 7%, but you start withdrawing 8% per annum after the 6th year onwards. That means 9,500 rupees per month is what you will be able to withdraw on the value after 5th year, because you let it grow for 5 years, and then thereafter you started your SWP of 8%. Total withdrawal thereafter will be 5.7 lakhs, but the residual value at the end of 10th year will still be 13.26 lakhs. So if you treat this as a deferred annuity and create an SWP even out of your debt schemes, you will be able to manage your cash flows better, both on the tax efficiency side also, with some residual value side also, and at the same time some SWP, which is a constant cash flow which will come to you. So it's not an indifferent cash flow which is based on the dividend declarations, etc. Dividends cannot be treated as a cash flow only because dividends can be skipped by the mutual fund houses depending on whether they have some reserves or book profits or not. So if you want a regular cash flow, which is your requirement as a senior citizen or for any other reasons, then SWP is the right way. Look at it as a deferred cash flow. Invest in a debt scheme, hold it for 3 years, 4 years, 5 years, and thereafter you start your SWP. You defer your annuity, and then you start generating better cash flow than the original yield of 7%. You can withdraw 8%, 9%, 10%, depending on what your cash flow requirements are. Naturally, your residual value will start coming down if you are withdrawing more and more from 13 lakhs to 10 lakhs, but you still not dipped into the principal. Even at 11.75% cash flows generation from 6th year onwards by deferring the annuity. Under asset allocation, do not take any risks in the other asset class, which is temporary parking. So if you think that you are following asset allocation as a strategy in your portfolios, if one asset class, which is equity, is risky, it is expensive, and that is the time when you're parking some money in debt, it's a temporary parking of your money. So do not take unnecessary risk in that particular asset class, which is the debt as an asset class, because from there you will be switching into equity as an asset class to rebalance for your asset allocation requirements. So these are some of the positionings of debt schemes in the mutual fund space, which can come in handy, which maybe you've not thought about how to utilize that space in the mutual fund for various needs of yours. So let me summarize. Think debt, think long term, just like equity. Invest when interest rates peak, and we are absolutely at the right juncture where interest rates are going up, and maybe in the month or month and a half they should be peaking, and that is an opportunity for us not to be missed at all. You may generate double-digit figure returns if you are able to capture that higher interest rate regime going forward and invest in the debt space. I've explained to you constantly rolling down maturity schemes or constant maturity 10-year G-Secs kind of products. But please remember that volatility will be part and parcel of your investment journey. If you hold it till maturity, if you are invested in a constantly rolling down strategy of 5-year constantly rolling down strategy, hold it for 5 years, you will get the captured returns. In between, after 3 years, if interest rates have softened, you want to exit with capital gains, entirely your choice. But volatility will be part and parcel. Stop looking at it intermittently. Otherwise, you will get perturbed and you will take wrong decisions at the wrong time. Use it as a deferred annuity, as I've explained to you, and ideal in asset allocation multi-asset strategies. There will be times, and according to me, equity will face some problems. There may be some sideways consolidation going forward in equity as an asset class also. But if you are able to capture higher coupons, higher yields in the debt space, you will more than make up for lack of returns in equities and asset class in the current scenario. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.